Good afternoon, ladies and gentlemen. Welcome to today's webinar, Tax Planning for Property and Other Investments, which I'm delighted that we're delivering in association with MHA. So for those of you who don't know me, I'm John Gaskell, Head of Personal Financial Planning here at ICAEW. I'll be facilitating the webinar today. So an extremely popular topic, got a lot of people that have engaged with this, and I think James is going to be particularly looking at family investment companies. But without, without further ado, let me pass across immediately to James, who will explain more. Over to you, James.
Right then, good afternoon, everyone. Thank you again for joining us for today's webinar. John's already introduced me, but I'm obviously James Kipping, tax partner at MHA. Today I'll be talking about primarily the tax issues and opportunities for holding investments in a corporate structure. Now, I'll focus mainly on property investments, but not exclusively so. I think looking at the time, I have about 40 to 45 minutes for the presentation, leaving hopefully 10 to 15 minutes for questions at the end to use up the hour. Those of you who have listened to my sessions in the past will probably remember I've often battled with time at the end, so I've got slightly less material this time. Hopefully that means we'll have plenty of time for questions. Moving on to the agenda or contents as it's stated on the slide here. Now I've broken it down today into 4 sections, starting with an overview of how investment companies are taxed, focusing really on the things you need to be aware of in deciding whether a company is appropriate. Now I've not gone into the real basics, I suppose. I want to focus more on sort of the planning aspects. I'll then look at how you might structure a family investment company if it's appropriate, and then what opportunities exist for those who already have investment companies. And then finally, recognizing that companies are not necessarily appropriate for everyone. In fact, that's far from the case. I will cover at a high level some alternatives that obviously you should be aware of. Starting off then, in terms of part 1 and the tax implications of holding investments in a family investment company or company. The most obvious or the most significant change recently has, of course, been the increase in corporation tax to 25% where profits exceed 250,000 from April 2023, therefore significantly increasing the overall effective tax rate that applies to property investment companies with that level of profitability. Now, of course, the lower rate of 19% still applies to profits up to 50,000, and then between 50 and 250,000, the marginal, well, that's the marginal rate band where the marginal rate applies, so that by the time profits reach 250,000, the effective rate or the corporate tax rate is 25%. What that means is the first 50,000 are taxed at 19%. The next 200,000 are taxed at 26.5%, being the marginal rate. Note that close investment holding companies do not benefit from the lower rate of 19%, and nor do overseas companies. Now, I'm not going to talk about overseas companies or offshore issues in this webinar, but I sort of state that at the beginning. In terms of what is a close investment holding company, it's basically one that does not exist for the purposes of carrying on a trade or property investments. This is not normally a concern for property investment companies. You should obviously consider capital gains and capital gains tax when deciding whether corporate ownership is appropriate, even if the investments are intended to be held for a long time. So individuals, of course, pay capital gains tax at up to 28% for residential property gains and 20% for all other gains. And of course, they have the annual exemption available to them, albeit that's now reduced to £6,000 for the current year and £3,000 from April 2024 onwards. Companies will pay corporation tax on capital gains, and the 25% rate now means that in some cases, it's become more expensive to realise gains in a company than personally. And then, of course, you must remember that there's potentially further tax to pay when profits are extracted from the company. So corporate ownership does present an element of double taxation in this respect. If someone wishes to wind up an investment company by selling investments and putting the company into, say, members' voluntary liquidation, the best overall effective tax rate on the investment gains is likely to be 40%, being 25% corporation tax, and then 20% capital gains tax on the distribution from the company. That is, of course, if it's taxed as a capital distribution, bearing in mind the various anti-avoidance provisions that can potentially apply to impose income tax charges. Again, not going into any detail, but the purpose of this really is just to highlight that there's that double taxation or potential for double taxation on sort of the profit or gain or growth in value within a company. The next couple of slides cover sort of trading versus investment, and the reason I wanted to cover this is because I'm still regularly asked whether investment companies can ever be regarded as trading and qualifying for tax relief such as business property relief for inheritance tax and holdover relief or business asset disposal relief for capital gains tax. The question is often around whether there can be a trade if there's a substantial amount of activity. You know, a very significant investment business, for example, requiring a significant amount of time and work and active management. The simple answer is no. They will always be investment businesses and not trading businesses. So this means they will always be within the charge to inheritance tax, for example. This is because of the investment exception to business property relief at section 105(3) of the Inheritance Tax Act, which I've copied on the right-hand side of this slide. Essentially, a business or interest in a business or shares or securities of a company are not relevant business property for business property relief if the business, or as the case may be, the business carried on by the company consists wholly or mainly, that's a 51% test, of one or more of the following, including the making or holding of investments. Now, this means that investment businesses where income is derived wholly or mainly from underlying investments, irrespective of the degree of activity undertaken, will almost certainly not be relevant business property, and they will not qualify for business property relief. Sometimes you may have a hybrid trading and investment businesses. So, for example, you might have a trading business that has retained surplus profits and gone and made investments. That's slightly different. And there are some well-known cases that consider this situation, such as Balfour, where as long as the trading activities predominate, again, it's back to that 51% test, when looking at various factors such as assets, income, profit, time spent, etc., the whole business can actually qualify for BPR, including the value attributable to the investment activity. But fundamentally, the business must be wholly or mainly trading. What I'm focusing on today is pure investment companies. They will never qualify for business property relief. To explain further, it's necessary to understand the distinction between the passive holding of investments and business, and a business and trade. And there are a couple of useful extracts from the cases of the executors of Moore deceased and Griffiths and Jackson on the right-hand side here, which I won't go through. But activities conducted on sound business principles and in a manner characteristic of commercial landlords will likely elevate the activity from passive investment to a business, but that is not to say it's sufficient to be a trade. If there is a business or a property investment, or rather, if there is a business, a property investment activity may then qualify for incorporation relief, for example, to allow the deferral of capital gains when a business is transferred into a company. You may well have come across that relieving provision. But that, again, does not mean that it's a trade. Fundamentally, and to sort of repeat the message again, an investment company will never be regarded as a trading company. From a CGT perspective, the transfer of investments or interests in an investment business will therefore not qualify for holdover relief under section 165. That's the sort of gifts relief. In terms of hybrid businesses, so where you've got a business that's a mixture of trade and investment, the test for trading is actually stricter for capital gains tax than it is for inheritance tax. and it broadly requires a trading company to be at least 80% trading. We're looking at similar factors to those I explained for inheritance tax on the slide here. I've given you the statutory reference for where the definition of trading company is, and for this purpose, and it simply says that a trading company means a company carrying on trading activities whose activities do not include to a substantial extent activities other than trading activities, and substantial for this purpose, according to HMRC's guidance, is regarded as being 80% or more. Now, overall, the issue is that investment businesses are always within the charge to inheritance tax, and that of course creates a desire for inheritance tax planning. However, the potential for capital gains tax on transfers makes such planning difficult. Before I looked at the distinction between trading and investment businesses, we were considering the tax implications of holding investments in a corporate structure. In other words, how those investments and the income derived from them are taxed. Usually I say that there needs to be a relatively significant investment or a long-term investment horizon, and possibly some opportunity to undertake other tax planning, typically inheritance tax planning, in how a company is structured to make a corporate entity the best advice. But there can be other circumstances, and really it's a kind of on a case-by-case basis. And the next couple of slides, I have some scenarios just to get you thinking, perhaps about your own situation or possibly clients if you're an advisor. Now, this particular scenario considers what may happen to landlords with significant borrowings when they feel the full impact of higher interest rates. So in this slide here, I said husband and wife property business. They're high earners, so they have other income of more than 150,000 each, so they're paying 45% income tax. They've got a 6 million property portfolio with a 50% loan to value. Okay, and their new or current mortgage interest rate's 5.5%. Say their rental yield is around 4%, and the costs associated with the rental business are estimated at 20% of income. And what I've done here is compare the tax position within a corporate structure and the tax position if they retain ownership individually. Now, this is just the annual income or corporation tax liability on profits that I'm looking at here. So in terms of the company, we get to deduct the full mortgage interest costs along with the running costs of the business to leave a profit of £27,000, which is below £50,000, so it's taxed at 19%, leaving a profit after tax of 21,870. Now, clearly they've got to extract that if they need it, but nevertheless, the profit after tax is 21,870. If they receive this income individually, yes, they've got a real profit of 27,000 after deducting all costs, but for income tax purposes, they can't deduct in full the mortgage interest. Instead, you add the mortgage interest back, leaves them with a taxable profit of 192, which, because they're additional rate taxpayers, would be subject to 45% income tax. So that's the income tax of 86,400, which is reduced by the basic rate relief available on mortgage interest to leave a tax liability of 53,400. So that's a tax liability of 53,000 on a profit of 27,000 pounds. They're losing money. Their effective tax rate in this rather extreme example is 198%. You know, clearly they will need to be doing something. So in this kind of scenario, maybe a corporate structure is best advice. In this scenario, I'm actually looking at a non-property investment business. Okay, so again, husband and wife investment business. Again, they're high earners, so they're additional rate taxpayers anyway. They've got 3 million to invest or invested in stock market investment. Again, I'm suggesting a 4% income yield, potentially split 60% dividends, which of course are exempt on the whole from corporation tax, and 60%. It's 60,000 pounds of interest. So 120,000 pounds of income, 60,000 dividends, 60,000 interest, and costs of, say, 1.5% of the value of the investment, so investment management fees or something. Okay. On the left-hand side of the table, we have the position for the company. Dividend income isn't taxed. The investment management fees can be deducted by the company, but they can't by an individual. Profit of £75,000, of which only £15,000 is taxed at the 25% rate, because it's a closed investment holding company, to leave a profit after tax of £71,250 within the company. For them individually, the position would be rather different. They can't deduct the investment management fees or other costs associated with the investments. They are subject to income tax at 39.35% on the dividends, 45% on interest, to result in a total tax liability of 50,000. So and therefore a profit after tax of just over 24,000. So a much reduced profit after tax individually than within a corporate entity. Yes, within a corporate entity, if they want to extract, they will obviously pay income tax, but there's a significant difference in the annual tax liabilities here, perhaps suggesting that a corporate environment might be the best solution for them if they don't need to extract the profits as income on an annual basis. So in this section, I'll consider firstly what we mean by a family investment company and how we might structure one, typically with inheritance tax and possibly income tax planning in mind. So at this point, we've decided that yes, a company might be the best approach. How should we structure a family investment company if we're considering, if say we have a pot of cash that we want to go and invest? Okay. So what is a family investment company? It's a private company whose shareholders are family members. In many ways, a company can be structured to provide many of the features of trusts, typically enabling parents to retain control over assets and flexibility on how to benefit their children or remoter issue, whilst accumulating wealth in a tax efficient manner and facilitating succession planning. Okay. I'll try and explain how that might be done. The key difference between a family investment company and a trust, or I suppose one of the key differences, is that family investment companies should not be subject to the relevant property inheritance tax regime and the associated entry charges and 10-year charges. So they can allow for planning to be done with larger sums of money than is typically the case with trusts, where lifetime inheritance tax charges are obviously a concern since the 2006 changes to the trust regime. Now, some of you may recall that relatively recently in 2019, HMRC set up a family investment company team, as they called it, to look at the use of these, given their recent popularity. Now, they found, as you would expect, that most family investment companies share certain characteristics. I've not set these out on the slide here, at least not in the manner I'm going to now try and explain them. So looking at HMRC's sort of release or consultation document at the time, they found that if they are set up with, obviously shareholders are typically members of the same family, usually over at least 2 generations. Shareholders can be direct or via a trust, and we'll come on a bit later to how trusts might be used in the shareholding structure. There are usually multiple classes of share, not necessarily many classes, perhaps 2 in most straightforward of cases. The rights attached to the shares often differ depending on the age or generation of the shareholder. So older generations, parents typically or grandparents tend to retain voting rights, whereas the younger generations hold rights to income or capital on a winding up. The company doesn't trade, obviously, but holds investments, often in the form of stock, shares, land and buildings. So this is typically what we see. They concluded that they do not tend to be used by the very wealthy, but they are used as a planning strategy, usually with the primary objectives of intergenerational wealth transfer and to mitigate inheritance tax. But overall, there was no significant evidence of non-compliant behaviour. So HMRC concluded that they are reasonable tax planning. And there's a link here. I'm not sure if you're going to be able to access it from the version of the slides that you'll receive, but type that into Google, the link on the right hand side there, and you'll find HMRC's summary. Essentially, though, what I'm getting at here is that they are reasonable tax planning when affected correctly, and essentially it's the rights attaching to different classes of shares that provide the opportunity for tax planning. So, a gift of shares to other individuals will be a PET. That's a potentially exempt transfer, so not immediately chargeable to inheritance tax. The value will be outside of the donor's estate for inheritance tax after 7 years, provided there's no reservation of benefit, but the donor might typically retain voting shares to give them control of the company. The principles of share valuation, the second point here, often provide an advantage. So shares are split between family members, and that may reduce the total value of assets held by the family, principally by the application of valuation discounts for part shareholdings. Okay, and the final point here is actually what I've already gone through, is just that family investment companies are taxed at up to 25% following the change to the corporate tax regime earlier this year. Now, this isn't as confusing as it looks. Okay, so probably the best way to look at how a family investment company might be structured is to consider a case study, in this case involving a UK resident founder or donor wishing to establish a structure for property investments, and alongside that undertake some inheritance tax and succession planning. So in this scenario, I'm suggesting that the individual or parents or donor has £5 million to invest. They may or may not need to access this capital at some point in the future, and or some of the investment return. If in many ways it's simpler if they don't need to access it, but if they do, that just needs to be considered when determining how the company is funded and the share structure of the company. So as I've said, planning is most straightforward when the donor doesn't need to access capital or the return, and in that case they might simply invest the £5 million in this case by subscribing for share capital, and I've suggested that they would do so in the form of A and B shares. So there may be a small amount of A share capital which has voting rights, and the bulk of the £5 million invested is done so into B share capital, which might enjoy capital and income rights. In this example, the B shares would be given away, and the majority of the A shares would be retained to ensure the donor retains control. The gift of the B shares would be a PET for inheritance tax, and after 7 years, the donor would only be subject to inheritance tax on the inheritance tax value of the retained A shares. Now, if the donor needed to retain access to capital, they might retain some of the B shares, or perhaps fund the company with a mixture of loan and share capital. There's various options here. Loans can cause complications, but typically they should be unsecured, may well be better to charge an interest, and then they allow easy access to cash subject to available liquidity, of course. Again, with care, the donor might be able to take a reasonable remuneration in return for directors' services and dividends on their retained shares. But again, care must be taken in drafting the articles and the share rights of the company. It's really, really important to get everything right at the outset, particularly drafting the articles of the company appropriately. Now, there are several tax traps, as I kind of think of them, that must be considered and navigated, and typically it's best to keep things as straightforward as possible. Now, the main things to watch out for are listed on the bottom right of the slide, and I'll talk in a bit more detail about the settlements legislation and how the gift for reservation rules may apply in certain situations. in the next 3 or 4 slides. So, well, firstly, what is the settlements legislation? It's an income tax anti-avoidance provision that can apply if property or any related property is or will or may become payable to or applicable for the benefit of the settlor or his spouse or civil partner. What does this all mean? Apologies, I thought I turned off notifications. Now, the definition of settlement is wide, and in the context of family investment companies, we must consider in particular arrangements where spouses and minor children can benefit from income, although outright gifts to spouses are excluded, provided it's not substantially a right to income. So you should be able to arrange shareholdings between spouses without an issue, but dividend waivers and the declaration of different dividends on different classes of share can create a settlement. And in fact, dividend waivers provide probably a good example of how the settlements legislation can apply. And that's what I'll try and explain over the next couple of slides here. Bear with me. Here we go. So on the subject of dividend waivers, there have been 2 dividend waiver cases, which hopefully will put the settlements rules into some sort of context here. In Donovan and HMRC in 2014, shares were held by husband as to 80% and wife as to 20%. In the case of Buck and HMRC in 2008, the disparity was more extreme, as husband in that case had 999 shares and wife had 1 share. In both cases, though, husband waived dividends so that wife received dividends, and the object, of course, was that these should be taxed at the lower income tax rate that applied to the wife in that situation. So running through section 624 of ICAEW, that's where the settlements provisions are. Now the waiver in this case by husband is the settlement arrangement. So therefore husband, the waiving shareholder, is the settlor. Now the income arising under the settlement is the additional dividend received by the wife, the dividend she wouldn't otherwise have received if it wasn't for the waiver in favour of dividends on her shares. And that I've called here the waiver enhanced dividend. Now, the property from which that income arose is most likely the wife's shares, or arguably the husband's shares, because he's the one waiving the dividend. Either way, this is property in which the husband had an interest. And the spouse exemption from the settlements legislation doesn't apply here because the dividend waiver is substantially a right to income. In both cases, husband was taxed on the waiver enhanced dividend. Now, this would equally be the case if the beneficiary was a minor child. In fact, it's probably most relevant to minor children because the settlements rules could easily be avoided at a husband and wife scenario by putting the shares into the right ownership between them before declaring a dividend. That's because if in the aforementioned cases, wife held the shares, or all the shares, they would be excluded from the settlements rules because they're not simply a right to income. But what about where the donee or the recipient is not a spouse and not a minor child of the settlor? Now, in this case, HMRC provide a rather generous analysis in their Trust and Estates Manual. And they say that where a person benefiting under arrangement is not a spouse, civil partner, or minor child, the settlements legislation will not apply unless there are arrangements under which the money will be paid or used to benefit the settlor. Okay, this means that the settlements legislation shouldn't normally apply to dividends declared in favour of adult children or grandchildren of any age, or indeed anyone who is not the spouse or minor child of the donor or settlor. So generally, we're worried about the settlements legislation where there are minor children as shareholders, typically, or if we're playing around with dividend waivers or different classes of share to put more income into a spouse that has a lower rate of income tax. Okay. What about reservation of benefit? This applies so that the value of a gift remains in the donor's estate for inheritance tax purposes if, after the gift, the property is not enjoyed to the entire exclusion of the donor. So in the context of a family investment company, what if, say, parents hold an equity stake alongside their children, but retain wide rights to determine dividend income? If in theory it's possible for them to distribute all income on their retained shares rather than on the shares given away or proportionally across all the shareholdings. Now, in most cases, I'm not sure that the gift of reservation rules would apply, but you ought to consider restricting the dividends payable through the articles. Again, highlighting the importance of careful drafting of the articles at the outset. Perhaps each class of share should have a fixed entitlement to profits. And I think I'll refer to this a bit later on when I talk about growth shares in planning for family investment companies. And that actually moves me nicely on to the third part, where I wanted to talk about tax planning opportunities for existing investment companies, because of course we frequently find ourselves in the position where we're advising existing businesses rather than those wishing to establish new investment businesses. Sometimes, of course, companies have evolved, from a trading entity into an investment entity, and of course, where people want to undertake inheritance tax planning, for example, the possibility of a capital gains tax charge arising on transfers of shares typically prevents, straightforward planning. So I'll just go through a couple of thoughts here for existing businesses. The first one, probably one of the most common planning techniques for existing investment businesses, which is the settling of some shares onto a discretionary trust. So this has both, potentially anyway, inheritance tax and income tax advantages. I'll firstly cover off inheritance tax. So, in this scenario, again, there's husband and wife investment company, and I'm suggesting 2 million net asset value. They own the entire share capital, and they want to provide for their adult children and or their grandchildren, but they don't want to incur the capital gains tax charges associated with a direct transfer. And perhaps they also want to retain some control over the shares. So in that case, we would recommend that they settle shares onto a discretionary trust, because they can benefit from holdover relief, not under the trading company rules, but under section 260 of the Chargeable Gains Act, because it's a chargeable lifetime transfer for inheritance tax. But care needs to be taken to determine the maximum number of shares that can be settled without creating an inheritance tax entry charge, bearing in mind that for inheritance tax, the transfer of value is calculated on the principle of the diminution in value of the donor's estate. So what we're doing is looking at the value of their shareholding pre-transfer and the value of their retained shareholding. Now here, if they give away 25% of the shares, you may think that that should be valued at £500,000. But because we're comparing 100% holding with a 75% holding, this is on the table here, you'll need to apply a discount, usually, to the 75% holding. Now, for that, a discount of up to 10% may be appropriate. So the transfer of value of 25% of the shares may be 650,000, which is probably the maximum we'd want to transfer here, because it's equal to 2 nil rate bands. So provided they haven't, the husband and wife in this situation haven't made any chargeable transfers in the previous 7 years, they could settle 25% of the shares with a transfer value of 650,000 without any IHT entry charge. Now, as I say, holdover relief would be available to them under section 260. There's no IHT entry charge, and after 7 years, they are only subject to inheritance tax on their retained shares. There'll be no relevant property charges within the trust in the first 10 years. or at least there shouldn't be. Technically there could be, but I'm not going to go into too much detail. There shouldn't be. Importantly, the value of the retained shares will benefit or should benefit from a valuation discount. And in this case, I've referred on the slide here to the ACCA technical fact sheet 168, which I've known HMRC refer to when trying to agree share valuations, and it supports a discount of up to 10% for a 75% holding. They actually say that a higher than 50% interest should attract a discount of between 5 and 10%. Clearly, it's based on the facts of each case. But of course, here, the discounted value of a 75% holding may be actually 1.35 million as opposed to the 1.5 million proportionate valuation. Now, as I said, that as well as the inheritance tax advantages, there are potentially income tax advantages or opportunities for planning when shares are held by a discretionary trust. So, and I should also say, so this is equally applicable to trading businesses as it is investment businesses. But in this case, I'm suggesting that there are two grandchildren beneficiaries, that the donors and trustees wish to benefit equally from the income arising to the trust. Now, of course, the income arising to the trust is likely to be dividend income from the family investment company. So they could pay dividends onto the trust, which suffers income tax at the highest dividend rate, and then distribute the net income with a tax credit that may be reclaimable by the beneficiaries. But that's unlikely to be the most tax efficient way of distributing income. It's also administratively burdensome. So actually what they could do in this case is appoint a revocable or defeasible interest in possession to give the beneficiaries a present right to enjoy the income as it arises. So assuming the beneficiaries have no other income, the company may then pay a dividend of up to the personal allowance and dividend allowance, so 13,570 each here, which then flows straight through to the beneficiaries and suffers overall no tax. Unless the dividend income is mandated to the beneficiaries, you would have basic rate tax payable by the trust, which would then attach to the distributions made to the beneficiaries. But by mandating the income directly to the individuals, you can avoid that layer of administration. Again, the care needs to be taken to ensure this is set up correctly, and again with the settlements legislation in mind. And I raised that because you may have seen HMRC's recent Spotlight 62, I think it is. So in that Spotlight, HMRC highlight that they're aware that some taxpayers have tried to take advantage of this to divert income to their minor children. Now, I'm not suggesting here that parents are trying to divert income to their minor children, but HMRC say in their Spotlight that people are doing this by, for example, allowing grandparents to subscribe for shares in their company at below market value, which are then settled onto a trust and dividends paid through the trust, often enhanced dividends on separate classes of share held by the trust in settlement of school fees and such like. Now, this is very clearly caught by the settlements rules, and in many ways it's surprising that HMRC needed to issue a spotlight to bring this to people's attention. But the message here is that when it's done properly, and there is a genuine settlement by people other than parents of minor children, then it's good planning. But again, just care needs to be taken in the implementation to get this right. So aside from trusts, what else can be done? Now, growth share planning is something we've done a little bit of with investment companies. Now, the principle of a growth shares plan is that a company issues new shares or a new class of share to the existing shareholders, typically, parents, for example, or grandparents, which captures only the future growth in value. So this is again referring to the rights attaching to that class of share. Now, those shares are then given away while they have little value, such that the tax implications of transferring those shares whilst they're of low value are minimal. And then over time, the wealth grows in the estates of the recipients, typically the next generation. Now, to achieve a low initial value, the shares will need to be issued with a hurdle value set somewhere above the current net asset value of the company. So this is where you need specialist valuation advice. And I'm not going to discuss the principles of growth share valuation. It's kind of beyond my area of expertise, but other than to say, I understand HMRC have tightened up on this somewhat, and they seem to expect a valuation that anticipates a future return, and whenever that might be, which is discounted back to today's valuation. So looking at this slide here, I had a scenario a while ago where we had a property investment company with a value of around 11 million, owned by 4 adults, 2 married couples, I think. Now, they issued growth shares with a hurdle value of £12 million. Now, those growth shares were valued, or independently valued, at £1 million for CGT purposes on the day they were issued. So whilst they didn't sort of benefit from anything on that at that time, they would benefit once the hurdle value of the company had been exceeded. Now, they could transfer those shares as a pet and suffer capital gains tax at 20%. But instead, they settled them onto a discretionary trust because that allowed them to hold over that gain and not suffer 20% tax on the £1 million valuation. But it also gave them, or the trust rather, also gave them flexibility as to who should benefit and when. Okay, and the final section here, looking at time, I'm about when I was hoping to finish, but this is, as I said at the start, a high level summary here. So whilst we're focused on using companies for investment, it's certainly not always appropriate. In fact, while an investment company can be very efficient in the right circumstances, quite often there are alternatives that are just as useful or even preferable to clients, particularly where they want simplicity. So I'm just going to cover off a couple here. This is by no means an exhaustive list or summary. So someone may have investment properties or wish to invest in property, but also be concerned about inheritance tax, understandably. While they want to do some inheritance tax planning, they're also concerned that they need the majority of the income. Now, HMRC's guidance at Property Income Manual 1030 there makes it clear, and I've put this on the right-hand side of the slide, it makes it clear that while income is normally shared based on the underlying ownership, joint owners can agree a different division of income. So property could potentially be put into the joint names or acquired jointly with income shared otherwise than in those proportions. There may, of course, be CGT to consider if gifting a share of property, but the principle that income doesn't necessarily need to be shared in accordance with that underlying ownership is what I'm trying to emphasise here. Now, you may need to consider the particular rules that apply to property owned jointly by spouses, the settlements legislation in relation to gifts to minor children. Spouses, of course, must share income equally for tax purposes if they jointly own property. But if the underlying ownership is unequal, they can elect to have income taxed in accordance with that unequal ownership, but they need to make that election. The settlements income will have the income arising from a transfer to a minor child assessed on the parent, as we've discussed already. And the final couple of points here. So just raise the concept of bare trusts. Now, bare trusts may be used where, I'm just going from the slide here, bare trusts may be used where a settlor wishes to make an absolute gift, but without transferring legal title of the property to the beneficiary or beneficiaries. So a good example might be where the beneficiary is a child who is unable or rather incapable of holding legal title. But they can be used far more widely. So, the point here is that the management of the trust is retained by the trustees. And as I've suggested on the slide, a bare trust could also be used as a vehicle to arrange that the value of an investment company passes to children whilst retaining a single shareholder with control. Now, bare trusts aren't a settlement for inheritance tax. They're someone is holding the legal title for the beneficiaries, absolutely. Okay, so they are outside of the relevant property regime. A transfer is a pet, so and the trust fund is in the estate of the beneficiary. The income and gains belong to the beneficiary. So again, watch out for the settlements rules. Although we often find that in practice, they're more likely to be made for grandchildren rather than children. Once a sole beneficiary reaches age 18, they can call for the fund to be transferred to them. And if a joint beneficiary reaches 18, they can call on the fund to be transferred if it is easily divisible. Therefore, investing into indivisible assets can enhance asset protection if there is more than one beneficiary, even in this case where actually the beneficiary is entitled to the assets absolutely. So we see bare trusts used a lot actually in inheritance tax planning with financial products. So for example, discounted gift plan can be created with a bare trust. And the principle there is that the settlor requires a single premium investment bond on bare trust for their beneficiaries, where the trustees have an obligation to pay up to 5% of the original capital back as an income every year. Now, the initial settlement or initial transfer is a gift subject to the 7-year rule. So it's a gift to the beneficiaries, typically the children. The 5% return in that case is provided without income tax. So this is not on the slide here, it's just a point that I noted earlier that I thought I should cover. And no taxable income or gains arise to the beneficiary until or unless the arrangement comes to an end and the investment is appointed out. But the point I'm trying to make here is that although this is a bare trust, essentially an outright gift with the trustees retaining legal title, asset protection is enhanced because the beneficiaries can't call upon the trustees to transfer the investment while the trustees have an obligation to pay the annual income to the settlor during their lifetime. So don't discount things such as bare trusts, which ordinarily you'd think, well, that doesn't provide enough asset protection. It may do. Partnerships. This is the final slide you'll probably be pleased to hear. Now, this could be a presentation on its own probably, but here I just wanted to introduce the concept so you think about partnerships or alternative structures as an alternative to companies. And in particular, limited partnerships registered and regulated by the Limited Partnerships Act 1907, which we don't see that often in practice, but may be used as a vehicle to hold investments as they can replicate some of the features of a trust, but without the relevant property inheritance tax regime and without the corporate tax regime that applies to family investment companies. So maybe we'll see more of limited partnerships now that the corporation tax regime has changed as of April this year. Now, just to run through the points on the slide. So why a limited partnership? Well, it has two types of partners. There are general partners who manage the business and bear unlimited liability to creditors, and limited partners whose liability to creditors is limited and who do not manage the business. Crucially though, a limited partner may only assign their share with the consent of the general partners, and a limited partner is not entitled to dissolve partnership by notice. So you might find here that this is appropriate where you've got parents, donors in this case as general partners who manage the business, limited partners being the children who have an entitlement, but they don't have easy access to the capital or a say in the running of the business. And as a final point, a limited partnership with an individual as a general partner does not need to file accounts at Companies House. And that could be relevant, of course, because, whilst investment companies, the small investment company accounts might not give a lot away, clients don't always want their information published at Companies House, as would be the case with a family investment company. And I think that brings me to an end. Thank you for listening.
Thank you, James. A wonderful summary of an awful lot of complex, different moving parts. Now, I know we've got lots of questions, be able to deal with a few of those whilst, excuse me, James, you might like to have a look at those in the meantime for a second, just if there are any particular ones you want to pick up. But I know that you very kindly offered that people be able to benefit from interaction with you after the event, and for data protection things, there's a little slide that's popped up there to help facilitate that. So do please take advantage of that. Perhaps if I just kick off with a very sort of general, almost professional refresher question, is can you just give a bit of a professional refresher on the double taxation issue regarding extraction from company and how that interacts with individuals?
Yeah, so right, so of course you've got the potentially a corporation tax liability. Let's imagine we're talking about property income here. Corporation tax liability on rental profits of up to 25%. So let's say you have £100 of property income, 25% leaves post-tax profits of 75. That may compare favourably to 45% tax rate that could apply individually. But if you extract the £75 or some of it, then of course you'll probably pay income tax at the dividend rates on that £75. So what that means is that when that's taken into account, the effective rate of extracting from an investment company is higher than if the income had been received personally. Of course, the company provides potentially other benefits. So the deferral of that income tax charge, you can roll up profits taxed at or reinvest profits taxed at just the corporation tax rates, and deal with income tax down the line if relevant. And obviously the scenario I outlined with mortgage interest deductibility provides an opportunity for some people within a corporate environment. Does that answer your question?
Yeah, no, I think it's a very nice summary. Thank you. Couple of particular ones, and then I'll move on to a couple of perhaps more general questions that have arisen. So the specific one is, if you wind up a limited company engaged in professional consultancy after 10 years, will the return of share capital with undistributed profits be claimed as entrepreneurial relief of 10% instead of 20% capital gains tax?
Simple answer is yes, it should be. So in that situation where you've retained profits in the company, otherwise not distributed trading profits, and you've got a pot of cash which is arguably surplus to the requirements of the business. So there's a concern often that taints the trading status, and therefore business asset disposal relief might not be available. I don't believe that's correct. I believe that in that situation, provided you've not gone and done something of an investment nature with that cash and it's just retained profits, then that shouldn't taint the trading status, and business asset disposal relief should be available, of course, subject to the usual conditions, 2 years, relevant, size of shareholding, lifetime limit of £1 million. There's a really good article that was in Taxation. It's probably about 10 years ago now, actually, but I'm not aware that anything's changed, where they actually talk about this. And I was led to believe at the time by the author, it may have been Kevin Slevin, I think, who's a good commentator on capital gains tax and entrepreneurs relief as it was. And he actually was understood that HMRC used that article in their training. So I think it's widely accepted that retained profits should not taint the trading status of a company for BADR purposes.
All right, thanks. Super answer. Thank you, James. I'll try to sort of lump some of the questions that we've been getting in more generally, because I know we're very short of time. Is the whole opportunity for Alphabet shares and structuring the shares to achieve different ends, if you like.
Yeah.
And some of the issues around the valuation of those. So we've had a couple of questions around the valuation of Alphabet shares. Could you maybe just elaborate a little bit? I know it's not your
Yeah, it's
Some of
really
the,
difficult.
I'll put the question another way, some of the issues that could arise in that as opposed to the specific.
Yeah. So, right. So clearly you've got to value shares based upon the rights attaching to them. So typically, I think you would value investment company shares on a net assets basis, but where you've got shares that only have a right to income, then that might not be appropriate. You perhaps use a dividend basis. So you've got to be careful as to what rights you're attaching to shares and what the expectation of income is. I suppose when making transfers. So I'm probably not answering this very well. Evaluation is not my
No.
I suppose the point I would make is that you can have some quite interesting scenarios where you've got, shareholdings that are spread around the family, and when you look at individual shareholdings, because of how valuation discounts work, the value of all the shareholdings added together might be lower than the net asset value of the company. Just suggesting that may be the case. It wouldn't always be. So I think it's one of those things that to give a general overview on the valuation of Alphabet shares is incredibly difficult, particularly if I'm not a valuation expert. But I'm happy to sort of take individual questions sort of separately, probably, and refer to colleagues if necessary.
I think you've answered the question extremely well, James, which is that it's case by case complex, and that you need therefore a specialist at some point for that valuation. However, the point, I suppose the broader point being, is that Alphabet shares create all sorts of planning opportunities. I think that the thing that came out from listening to your excellent presentation is that actually there are a lot of planning opportunities by using Alphabet shares, providing that care is taken to make sure it's being done properly.
Yeah, agreed. Yeah, agree.
Okay, perfect. And the last question is, I think, very useful, practical one is, when it comes to the costs that are involved in terms of setting and managing a fee, could you give some perhaps illustration around that and maybe the size of the assets that would be needed to make it?
Yeah, I should have covered this actually, and I kind of change my mind on this sometimes. But I would say if someone comes along today and says, I've got X amount of cash I want to invest, what's the best structure for it? Then you've got all the questions around, well, what you're trying to achieve, is there inheritance tax planning, do you need the income, etc., which probably is the starting point. But I don't really think that we would go down the family investment company route if there's less than probably 2 or 3 million to invest. And that's not to say it would never be appropriate. And equally, it's not to say that higher sums of money means it's automatically appropriate, but that's probably a rule of thumb. In terms of the costs, well, yeah, you've got your kind of ongoing compliance costs. Would always have to cover off what we would charge for accounts and all that sort of stuff. Actually, a company can provide an environment to claim more relief for costs, investment management costs, for example, than you would be able to individually. So it's not necessarily down to cost. It's just, well, actually, is it the most appropriate structure given the other things you can do with certain sums of money, I suppose.
Yeah, thanks, James. So just to summarise, I suppose the clear message is here is make sure that you have a really good understanding of goals and objectives and what you want to achieve, and then start to have the dialogue, excuse me, around people such as yourself and bringing in particular experts so that you navigate through this complexity to achieve what it is you actually want to achieve. That comes out to me very strongly. And the interaction with trusts, all sorts of planning opportunities in here. And with that in mind, you will be receiving a survey, I think, from us. And I'm always keen to hear what other subjects you'd like us to discuss, because there's so much material here I think we can work on going forwards. Perhaps trust is one of those, and the interaction between fixed and trust would be something else to consider. So let us have your feedback. But just a massive thanks to James and to MHA for such an informative session. And as I always say, James, it's like listening to Wikipedia, listening to deliver it. It's just wonderful stuff, and I'm sure everybody's really appreciated it. And lastly, if you're not a member of the personal financial planning community, then do please join. It doesn't cost you anything to do that. And it's a really good repository. I think there'll be a copy of these slides posted up there, or the recording rather. So do please join, and I look forward to meeting some of you again very soon. Thank you, Jane.
Thank you.